Hello everybody. At this time we are talking about expected return. The expected return is the profit or loss that an investor anticipates on an investment based on historical rates of return. The expected return is not guaranteed, but historical data sets reasonable expectations. Therefore, the expected return figure can be considered a long-term weighted average of historical returns. And then how expected returns work? Expected return is the estimated amount of profit or loss an investor can anticipate from an investment over a period of time. It is calculated by multiplying each possible outcome by its profitability and then summing those values. This helps investors compare the risk and reward potential of different investment options. While it doesn't guarantee actual returns, it offers a rational forecast based on historical performance or estimated probabilities. Expected return is widely used in portfolio planning and risk management to align investments with financial goals and risk tolerance. It is especially relevant for assets like mutual funds, stocks, and bonds. And then why expected return matters in investing? Expected return plays a central role in investment decision making because it helps align asset choices with an investor's risk tolerance and return objectives. Beyond serving as a performance forecast, it acts as a foundation for critical financial practices such as portfolio optimization, where assets are selected to maximize return for a given level of risk, and risk management, where potential downside is assessed in probabilistic terms, and expected return is also embedded in scenario analysis and corporate valuation models, enabling analysts to quantify uncertainty and justify strategic recommendations. And then expected return in portfolio theory. In modern portfolio theory, the expected return is a key component in determining the efficient frontier, which represents the set of optimal portfolios that offer the highest expected return for a given level of risk. The expected return of a portfolio is calculated as the weighted average of the expected returns of the individual asset in the portfolio, with the weight representing the proportion of the portfolio invested in each asset. The concept of expected return is also central to the capital asset pricing model, or CAPM, which is a model that describes the relationships between risk and expected return. According to the CAPM, the expected return of an asset is equal to the risk-free rate plus a risk premium that is proportional to the asset's beta, which measures its systematic risk. And then how is expected return calculated? Expected return is calculated using various methods such as asset allocation, diversification, and compounded return, which consider the potential performance and volatility of different investments assets. Asset allocations involve strategically distributing investments across different asset classes, such as stocks, bonds, and cash equivalents to optimize risk and potential return. Diversification plays a crucial role in spreading investment risk by investing in a variety of assets within each asset class. Meanwhile, compounded return accounts for the effect of reinvesting earnings, enabling the potential for exponential growth. These principles are essential in investment analysis and risk management, providing a framework for building a well-balanced and resilient investment portfolio. And then we move to limitations of the expected return. To make investment decisions solely on expected return calculations can be quite naive and dangerous. Before making any investment decisions, one should always review the risk characteristics of investment opportunities to determine if the investments align with their portfolio goals. For example, assume two hypothetical investments exist. Their annual performance results for the last 5 years are both of these investments have expected returns of exactly 8%. However, when analyzing the risk of each, as divided by the standard deviation, investment A is approximately 5 times riskier than investment B. That is, investment A has a standard deviation of 11.26% and investment B has a statistical metric use of 2.88%. Standard deviation is a common statistical metric used by analysts to measure an investment's historical volatility or risk. In addition to expected returns, investors should also consider the likelihood of that return. After all, one can find instances where certain lotteries offer a positive expected return despite the very low chance of realizing that return. And then, why expected returns matters to investors? The first reason, central to portfolio construction and asset allocation. Second, higher expected returns typically come with higher risk. Third, helps compare investment opportunities across asset classes. Fourth, a key component in evaluating risk-adjusted performance metric like Sharpe ratio. And fifth, influences long-term financial planning and required savings rate. And then how is expected return used in finance? A crucial component of financial theory and company operations. Expected return computations are found in the well-known Black-Scholes options pricing models and modern portfolio theory models. It is a tool for figuring out if the average net outcome of an investment is positive or negative. Through its insights create fair expectations, the computation is typically based on historical data and cannot be guaranteed for future results. I think it is enough. Thanks for watching.